Hello, everybody. This is Rick Geiler with Silverside Insurance here in Scottsdale, Arizona. Thanks for being with me. What we're going to talk about today is single premium life and how we can use it, given some of the challenges of today's marketplace and some of the client concerns that we're seeing nowadays. And the title is called Repositioning Assets, because as we're going to look at, we don't necessarily need to identify new clients with new money they're looking to put to work. A lot of us already have clients that this concept of single premium life, we can leverage up what they already have or what we're already working with. So we'll get into that a little bit more. Let me get started. A little background on what we're looking at in today's marketplace. Everybody's going to say, okay, I know Rick's going to show us some kind of a chart of either the S&P 500 or the bonds or whatever. And yeah, I think it is important to give a little backdrop, especially like here, this is a chart for the last couple of years of the S&P 500. And when we're talking to people about their assets and about planning their futures, the stock market, a lot of the environment is a big issue. It's on everybody's mind. So the point of this one, we could have gone with different scales. This goes back about 2 years. It shows some pretty good volatility, but more or less an upward trend. But of course, we see at the tail end here, the last couple of weeks are looking like maybe we're headed for another downturn. You never know, because we see a couple times back here where we were looking at downturns and we turned back up. So this is driving folks to wonder, how much market exposure do I want to have? I've had a pretty good run the last few years. Maybe I've even gotten some double-digit returns. But do I want to try to get into something a little bit more fixed? So I'm sure we've all had some conversations with clients about those kind of things. But when we're looking at fixed, you know, you're looking at CD rates, which is a fixed, safe money, I guess is the word we like to use sometimes. CD rates, that's a bank rate. It says national average is 2.6% APY yield. I'm not sure exactly where they're getting that. It seems a little low to me. That is some statistic that they do a lot of work to generate. But the point is, CD rates are generally well under 1%. Unless you want to go out to a longer term. Maybe you can get significantly over 1.5, somewhere in that range, but still very low from what people are looking to do as far as put their money to work. And then, you know, the bond rates are right in line there, about a 2% yield on a 10-year note here. And the stock market volatility is high. And that Chicago options, the VIX at 25.69, doesn't necessarily mean a whole lot to us, but just from a historical perspective, the average on that is about a 10 to 12 range. So you're looking at high market volatility by multiple measures. So we've talked to a lot of our clients about fixed annuities, sometimes variable, but particularly fixed. The big challenge there is the low bond rates, low rates across the board have given us low fixed rates in annuities. The pars and caps, you know, are 4%. S&P point to point, so actually pretty competitive cap. 4.5, 5 is very competitive. Pretty low compared to what we were looking at a few years ago, and we're not seeing the kind of bonuses that we were. But what we're seeing is more elaborate designs. This is a LIMRA statistic. Earlier this year, 136 out of 184 fixed annuities on the market, or fixed indexed annuities on the market, included a GLWB, an income rider. So that's been a big design where the insurance companies are trying to figure out, okay, what can we do to add some value here on top of 1-2% fixed rates? And they can offer lifetime income by pooling risk. So they're adding some value there. But as we see, you know, in the next bullet there, LIMRA also estimates that 70% or more of people are never going to use that rider for whatever reason. The corollary statistic is most of them that do use the rider trigger it in the first year or two, and kind of reducing the benefit. They're not getting the roll-up rates that are embedded in there. So even though for a lot of folks income rider annuities are a good option, especially if money is for supplementing Social Security or if it's for spending. But if it's not necessarily for spending, we're seeing, as far as on the annuity side, there really aren't that many accumulation products out there right now. There's some MYGAs, multi-year guaranteed annuities, that are pretty simple. They're basically, for lack of a better description, they're the insurance version of a CD. Put your money in here for 5 years and you get 3% a year. And there's really not a whole lot more to it than that. You're not probably going to get any more than that, and it's guaranteed that you're not going to get any less than that. So most of the income products, there are some other ones with some longer term chassis that can be effective, but a lot of people don't want to get involved in a 14, 15, 16-year contract. So on the annuity side, we're not seeing the kind of options we were as far as positioning assets. Maybe for income, but not so much for accumulating and positioning assets. So a really powerful concept that's moved to the forefront is the single premium life that we're talking about here today. And not only because it's a way to position assets, but because it can address some of these client concerns. Now, particularly living longer is a big concern you hear about. The single premium lives, the ones we're going to illustrate here later today, they do have return of premium options, and there are cash withdrawals you can make. They're not really designed for income. So the single premium life is not big at addressing that concern, but the next two concerns, it's an extremely powerful concept. For health-related expenditures, the single premium lives that we are going to talk about or really highlight later on are very powerful at leveraging assets up to use for those health-related expenditures. And they also are going to help plan for wealth transfer. This money is not to be spent. It's supposed to go to the kids, the grandkids, whoever, the church, whoever it may be. That can be a good, powerful tool. So we talk about single premium life. We talk about all these wonderful things it can do for us. It can leverage money up. On the single premium life, it does all these wonderful things. It has these tax advantages. It leverages your money up. It has better crediting. Yes, the commissions are generally higher than what you see across the board in annuities, particularly income or particularly in accumulation style annuities. So, okay, great, Rick, single premium life, I've heard this before. I probably even agree with you. It does all these wonderful things, but what's the catch? Why would everybody not do this? Well, a lot of people should, but the couple catches that may be relevant are you really need a lump sum or significant funding source readily available, and generally non-qualified money is what you're going to need. So mostly to use the most powerful products, you need a lump sum of non-qualified money, 50, 100,000, maybe a little bit more. If you get less than maybe 30 or 40,000, you're starting to lose the power, and I'll show you a little bit why later. And also for your more powerful single premium lives, you don't need to be in perfect health, because they're designed for folks maybe in their 60s, 70s, even 80s. And by that age, most people have had, they're on a couple prescriptions, or at some point they've had some health issue come up. So you don't need to be in perfect health to qualify for most of the good plans, but you do need to be in decent health. So that's another thing when you're presenting or when you're talking to your clients or your prospects about single premium life, and you present it to them and they say, well, yeah, that's something we need to think about. Well, if you like the concept, you better think about it soon, because if you wait until you've had that health issue, you wait until you've had maybe a stroke or a minor heart attack, even if you're on a pretty good recovery schedule, you're going to have a hard time qualifying for the really powerful leverage products if you've waited until you have a significant health issue come up. Also, every birthday that comes and goes, you're going to get a little bit less bang for your buck. The leverage on a single premium life is going to be driven by your age. So anybody who's got a birthday coming up who's thinking about getting into a single premium life, now's the time to do it. Don't wait till after your birthday. You're going to lose a little bit of bang for your buck. So we're talking about either new or existing clients. I put ages 40s to 80s here. Really, I would say, just off the cuff, probably 75% of the people that we work with on single premium lives are in their 60s or 70s. There are some products and there's some designs that go down in their 40s, folks in their 40s, maybe even a little bit younger. And a couple of the really good products list you up to age 85. But once you get into your mid-80s, you're really not getting a whole lot of leverage on your money. So you need to think about this. It might be really good for a wealth transfer issue, but you're not going to leverage it up a whole lot for health issues as you get older. And then these are the kinds of money that you can use for this. Annuity money, I'm going to show you two single premium lives that have a premium bonus. And that's basically designed for folks if you're moving annuity money over and you say, well, you know, I want to get this done now, but my annuity still has 3, 4, 5% surrender charge on it. But I may be better off paying that surrender charge and getting my money leveraged up now rather than waiting 2 or 3 years for that surrender schedule to diminish. But then I'll be that much older, so I'll get that much leverage when I do move it. So the premium bonus is kind of designed to help offset any surrender charges from annuity money coming in. Life insurance cash value. Here's another thing. When you're doing a fact finder with either new relationships or existing clients, they might have some old universal lives, or they might have a cash value whole life where they don't want to continue making premiums. It has cash value, or a universal life that the burden of the cost of insurance is starting to really drag on that cash value, and it may even lapse at some point. You can take that existing cash value, move it over to a single premium life, and now you're going to have guaranteed values permanently without any additional investment. So that may be something to take a look at when you're doing fact finders. Do you have any cash value life insurance that maybe we want to move to a single premium life where it's going to be, all the values are going to be guaranteed from day one, and you're not going to have to worry about lapse notices or additional premiums? CDs, money at market risk, of course. We're sitting here, the markets have had a pretty good run, but we're also seeing some volatility. We're seeing the possibility of a big pullback. You know, maybe it's time to get a little bit of money out of pure market risk and get it over to a fixed product that with some index strategies, it still might give you some pretty good growth if the markets continue higher, but you're not going to be at risk of taking a 30 or 40% haircut like we saw the market do in 2002 or 2008. And then, of course, there could be other new money sources that might be appropriate to take a look at a single premium life on. So I want to move pretty quickly here. I want to get you guys out of here, but I wouldn't feel like I gave you your money's worth unless I got into a few product specifics, even a few numbers. But I'm not going to take the time to go through a bunch of company compliant full illustrations and full product guides. So I'm going to abbreviate a little bit here. I'm also going to give some of my personal opinions. So I'm going to call this next section, this is a product review. And on the products that I'm talking about or mention or highlight, I encourage you, if you want to know more about them, contact us to get a full illustration, full carrier compliant product guides, brochures, and everything, because I'm not going to have time to give every single detail, but I want to highlight some of the power that we have access to on some of the products that we really think work well in today's marketplace. So here I'm going to look at, this is one, and if you know us at Silverside, you know we've been working with the Sagicor on their fixed index single premium whole life for several years now. And this is really, when it hit the market back in, it was late 2007 to early 2008, it was really revolutionary, because single premium whole life or single premium life, it could include some kind of a UL with some embedded guarantees, could be on a whole life chassis. Regardless, single premium life is not a brand new concept. It's been around for a long time. This product hit the market, and it really had some it included several bells and whistles, shall we say, that really made a splash. It included that cash premium bonus that I talked about. It was simplified issue to Table 4. You take an application and you do a phone interview, and if your client is underwritten as a Table 4 impairment or better, they qualify. The only two rate classes are tobacco, non-tobacco. They won't stratify a preferred, a standard, anything. It's either they qualify at a Table 4 or they don't. And that's off just a phone interview. Sagicor will go to APS. A couple of the others I'm going to mention here too. Sometimes we'll go get APS, go get doctor records. We're not going to talk much today about fully underwritten products where you would go and take a paramed exam or maybe even a full exam. We're not going to get into that much today. That is part of the single premium life marketplace, though, and those might be options you can look at. But today we're going to highlight the Sagicor, and then I'm going to highlight the Equitrust here in a second. And these are going to be more transactional. They're going to be simplified issue. They're going to be something you can put in front of your client today, and you can discuss, hey, should we move forward with this? Is this the time? And they're going to be very powerful. Return of premium, both on this and the next one I'm going to talk about. Return of premium at any time. You put $100,000 in today, and you want it back tomorrow, next year, 10 years from now. Guarantee you're never going to get back less than that $100,000. And of course, the caveat that the carriers are always going to put, net of any kind of loans or withdrawals or encumberment against it. But assuming you don't make any kind of loans or take any kind of loans or withdrawals, your $100,000 is always going to be guaranteed with this product. There's 3 crediting options. 2 of them are index crediting. So we may be able to get some pretty good growth if the markets continue higher. If the markets flatten out, we're going to have some good guarantees. And probably the thing on Sagicor, in my opinion, that stands out is their illness benefit. Their chronic illness acceleration is technically an acceleration of the death benefit, so it's generally going to be considered to be a tax-free benefit. And that's triggered on just 2 of 6 ADLs. You go to your doctor, you fill out the claim form, your doctor says, okay, so-and-so's having problems with these 2 of 6 ADLs, and then you file the claim, and once it's processed, you draw. At Sagicor, it's essentially 3% per month of the death benefit in cash. You spend it on whatever you need to. So personally, I think that is probably the richest illness benefit in the class in the simplified issue single premium life. And there are a number of carriers that have products, and a lot of them have strong features. But on that one feature, I don't think any of them beat Sagicor. The commission is pretty good. 8% is the base commission. It does reduce at older ages, and Sagicor is A- excellent with AM Best. So again, I'm going to talk. Here's another product that's really making a splash these days. Equitrust has a strong product. They're aggressively marketing it. You may have seen they're running a bonus program for the next couple of months. So if you're looking to do some significant premium, that's a way you can put some serious money in your pocket. And all those details are available on our website, by the way. Don't really have time to get into some of that at the moment. But the Equitrust Wealth Max bonus has a 12% premium bonus. And it's simplified issue, very similar underwriting to the Sagicor. It has a return of premium. It has crediting options, 4 options, 3 of them are indexed. So again, you can get some good upside in that. It has a 2 of 6 ADL cash illness benefit. That one on Equitrust, the main benefit, the ADL triggered benefit, pays 2% of the death benefit. One thing I really like about the Equitrust is it doesn't cap out. If you have a bigger face amount, you can accelerate 2% of that, pretty much whatever your face amount may be. Whereas on the Sagicor one, you get 3%, but there is a cap on how much they'll pay on the Sagicor. So if you're looking at bigger chunks of premium, or maybe a little bit younger people who are going to get more leverage and have a higher death benefit, you may want to look at the Equitrust, although it'll take a little bit longer to accelerate that death benefit in the event of illness. You can probably accelerate more. and the commission's a little bit higher. Now at Equitrust, though, you have to look. There are actually two commission breaks at higher ages. So if you're really commission driven, you might want to double check which product may pay you a better commission. Personally, I think the commission on both this and the Sagicor is pretty good, and it's pretty comparable, and you should probably just use whichever product fits better and not worry a whole lot about whether you can get another 0.5% on one or the other. But at the same time, understand everybody's got bills to pay, and that's always got to be something we're concerned about. So take a look at the Equitrust for the max illness benefit, and the commission's pretty good. The carrier rating's a little bit lower. So if you're doing business through banks, or you have a broker-dealer, or you have anybody who's going to scrutinize that kind of thing, that has come up and may be an issue. At the same time, Equitrust is a long-term, very stable company. They've got a lot of money behind them. I'm not personally really concerned about the rating or the company's stability as such, but I do know that sometimes we get scrutinized at what we're showing people, so that's something to keep an eye out on for Equitrust. But very powerful product, huge splash Equitrust is making in the market right now with this one. And now I'm going to go through some numbers real quick here, and these I did take off of the carrier-generated illustrations, but I'm summarizing here a little bit. Actually, this template here is one of Sagicor's, so these are actually numbers that they have generated recently. But also, you always have to ask for a current illustration. Whatever numbers I'm showing you here today, they could change by tomorrow. If you're watching a recorded version of this webinar, numbers can change from time to time. So these are just for discussion purposes to see what kind of leverage and what kind of power I'm talking about. Here you got a female age 62, which is kind of 62 or 65 seems to be the rule of thumb for what to illustrate as an example. And basically, if you look at the immediate leveraging on this is going to be between 2 and 2.5 times. She's going to have that death benefit available, 248, or on the guaranteed side, a little bit less. And then, as you can see over time, at the end of year 15, the guaranteed value, that's going to be the face amount, $207.94 on the Sagicor. That's going to be the lowest contractually that death benefit can ever go, regardless of if you're index crediting or whatever declared rate you might be using. Even if those go to the minimums and they're not pushing your policy higher, this is always going to be guaranteed to pay a $200,000 plus death benefit. And again, the power, look at the bottom here, the chronic illness monthly benefit is essentially 3% per month of the death benefit. Again, that's capped at $250,000 is the most Sagicor will accelerate. So for this model, that's not really going to become an issue. There is a little bit more to that calculation, but I don't want to get into it today. I boiled that down into a nutshell for us a little bit. But again, that's a very powerful, that's a one-time trigger at Sagicor. You take the claim form to your doctor, you get certified that you cannot perform, you need substantial assistance, I believe is the exact wordage, in performing 2 of the 6 activities of daily living, and you trigger that monthly benefit, and you're going to draw that in tax-free cash for 33 months. You're not going to have to show receipts, you're not going to have to be in a nursing home. Spend the money on whatever you think you need to, given your health situation. So I'm going to look at the numbers. And I'm going to try not to pan back and forth much on us here, but these are going to be the Equitrust numbers, and as you can see, they're going to be very similar. The death benefit year 1 maybe a little bit higher. The face amount, or the guaranteed minimum death benefit in this particular case, is $196,000. Is a tiny bit less than on the Sagicor. The current side is including assumptions based on index crediting or current fixed crediting. So that's a little bit theoretical, but as you can see, that is going to grow over time on you, given some relatively conservative assumptions. Either the Sagicor or the Equitrust are going to grow over time. It just depends on how the markets are doing and how you choose to allocate. Again, we need to do full illustrations to try to really grasp the details on that. And then you see down the bottom two columns is the chronic illness monthly benefit. You're going to see that's a little bit lower. That's going to be 2% at Equitrust. You can actually accelerate that death benefit a little bit faster if you're confined at Equitrust. There is another option, and you can get a quicker acceleration. Or on both of these, there are also lump sum options. But that's something that maybe we'll get into when we're running a full illustration for you. This is how it lays out here. And again, that chronic illness monthly benefit is technically an acceleration of the death benefit. You're getting your death benefit early because you are impaired by this illness. So as far as the technicality, that's death benefit. It's going to be treated as such for tax purposes. Now, again, we always on these webinars and informational pieces, we have to give the disclaimer that this is not intended to be tax advice, and you would need to consult an expert on that, but we do need to suggest how some of the power might be for you there. And then moving on, those are two of the best indexed single premium options, simplified issue. Those are for folks with a lump sum of tax-free cash who are in reasonably decent health. There's plenty other things on the market as far as single premium life, or even there are some multi-pay options, or there's some stuff we can do with qualified money. I kind of kept the focus today for lump sums of non-qualified money for folks in decent health. There's simpler designs from both Sagicor and Equitrust, and there's a few other carriers out there that have some simple designs too that you might get a recommendation from us on from time to time. Sagicor has what they call their interest-sensitive single premium whole life, is essentially the product I highlighted for you. It has the return of premium, it doesn't have the premium bonus, and it doesn't have the index crediting. But other than that, it's going to work about the same. It's going to pay a little bit higher commission. And at Equitrust, they have what they call their WealthSure, which is very similar to the WealthMax bonus I showed, although it doesn't have the bonus and it does not have a return of premium. But it does have that rich illness benefit, and that pays a 15% commission. So, in my opinion, as far as double-digit commission single premium lives out there, that one's going to be very tough to beat because it does have very rich client benefits to be paying that kind of commission. For higher health risk, if you say, well, I got a client, but they've had more health issues, I'm not sure they could be a table 4. There's a couple other carriers. I just mentioned two here. There's Fidelity Security Life. There's Baltimore Life. Fidelity Security has a version that goes out to a Table 12 risk, and that's largely going to just be a wealth transfer product. At Table 12, you're not going to get a whole lot of illness benefit, but you're still going to get some leverage and some wealth transfer. Similar with Baltimore Life. Baltimore Life pays a good commission. It doesn't have a really rich illness benefit, but it pays a good commission, and it has good leveraging for wealth transfer. So that might be something you hear maybe recommended from here from time to time. And then we can talk about LTC. Now there's a confusion sometimes about chronic illness, and I'm showing you a monthly benefit of $3,000 or $4,000 if you are on 2 of 6 ADLs. That is technically life insurance. That is not technically long-term care. There are several on the market, and I'm mentioning here 3 of the good ones, or three of the ones you might get recommended from us. There's several good ones out there. But Genworth has their TLC series that has a true long-term care rider. It's going to create a separate pool of money for long-term care. It's not just going to be accelerating that death benefit. It's going to create a complete separate pool of money specifically for long-term care. And that's going to be a HIPAA-compliant rider. In many states, that's going to be considered health insurance. You may need a health license for either the Genworth, the MoneyGuard, or the Asset Care series from State Life. So that's a more complicated design than what I was showing with the Sagicor and the Equitrust. Generally speaking, I would say it would be for folks with more assets, and they might say, hey, I have 100,000, I have 200,000. I'm not really concerned about leveraging this up for wealth transfer. I'm not really concerned about this growing. What I want is maximum leverage if I get sick. Or on some of these, there's designs for joint benefits, husband and wife. We want to both be able to draw on this money if we have significant health issues. So again, your LTC products are going to be a more complicated design. They might require a health license. They might require more underwriting. In most cases, they will require more underwriting than just the application phone interview on the single premium lives. But they can also be very powerful tools. So I wanted to mention those today. I think I'd be remiss if I didn't. And then there are some LTC annuities. There are annuities with a long-term care rider. Now, don't confuse the long-term care rider annuities with some of the income annuities that have some kind of a multiplier. You can get double your monthly income amount if you end up in a nursing home or something to that effect. Those can be powerful tools on the income rider products. But these LTC annuities I'm talking about here, there's one from Forethought. There's the Annuity Care series from State Life, which in my opinion is really the state-of-the-art in the market right now. Then there's other designs out there. We're not seeing as many of the LTC annuities as maybe were out there a couple years back. But all of these products are going to address the concern of standalone long-term care, where benefits are being more difficult to define now. There's fewer guarantees in standalone long-term care. There's the if you don't use it, you lose it complaint about standalone long-term care. So anything where you're using a chunk of assets and repositioning it and leveraging it up can oftentimes be a lot more powerful than standalone long-term care. And in fact, we see fewer designs, fewer carriers involved in that space right now. But there are annuity options, and then there are some options here. The theme today is single premium life, but we do have some angles we can play if you say, hey, I don't have $100,000, but I could put in $10,000 a year for 10 years. There's some designs like that. Or if I say I have qualified money, I have a big pool of qualified money, I don't necessarily want to take a lump sum and pay the taxes on it to move it into a non-qualified life contract. What other options are there? Now, incidentally, I think oftentimes, and this is going to depend on your tax bracket, and this would get you'd need your client's accountant involved here on what this impact this would make on their tax liability. But oftentimes, converting some qualified money to fund a single premium life can be an effective design. But that's probably more than what we can get into today. I don't want to run over time. I try to keep these to about 30 minutes because that's the extent of my attention span, and so I don't like to ask anybody else to have much more than that. But what I want to summarize and say, with single premium life, the real power of it is you can get sales from new and existing clients using leverage and tax advantage of life insurance. Tax advantage is really key because in this low rate environment where bonds are paying 2% and CDs are paying 1% and fixed rates are so low, if we use a life insurance chassis and get that extra tax advantage, there's some value that we can pick up that with other vehicles we have trouble picking up. So I'm going to leave you with that today. Give us a call. Look at some of the single premium life options. You're really probably your first options for folks in decent health with a lump sum of money is probably going to be to look at either the Sagicor fixed index single premium life or the Wealth Max bonus. If you have more issues or there's some other things, you may get one of the other designs from us. But give us a call here at the main office number. You can visit our website. Again, on our website, you're going to see some promos, carrier-based promos, some promos that Silverside is currently running that you might qualify for with this. Also, there's some other products out there that we like to promote at the moment. There's some annuity options that we really like that we think are underserved. So go ahead and visit our website, give us a buzz, and we'll get you what you need to approach your clients with some really powerful concepts. All right, thanks for being with me today. I'm going to sign off, and we'll see you next time.